By law, your credit card statement has to warn you. Right next to that line that says minimum payment due, there's a small box your card company is legally required to print. It tells you exactly how long you'll be in debt and exactly how much extra you'll pay if you only make the minimum every month. Almost nobody reads it, and here's why that matters. The share of cardholders making only the minimum payment is at its highest level since at least 2015. That's not a guess. That's straight from the Consumer Financial Protection Bureau's most recent report on the credit card market.
The Consumer Financial Protection Bureau will soon have oversight of digital payment services that handle at least $50 million in transactions annually. For the latest, want to bring in.
Well, we saw what happened in the years leading up to the financial crisis, mortgages that were setting people up to fail, and it crashed the economy.
Published at the end of 2025. So this is one of the most common money decisions in the country, and most people have never actually run the numbers on it. Today we're going to run them. If you only pay the minimum on a credit card, every month, on time, no missed payments, no new charges, what really happens? How many years are you in debt? How much does it actually cost? And is there ever a situation where it's the smart move? The honest answer is more uncomfortable than most people expect. Let's get into it. Most people paying the minimum aren't being careless, they're being squeezed. Recent surveys have found that many people carrying credit card debt say it started with an emergency or unexpected expense, things like medical bills, car repairs, or home repairs. Others say it came from covering everyday expenses like groceries, utilities, and other household costs. For a lot of households, the credit card isn't a luxury. It's the gap between getting by and falling behind. So the minimum payment becomes the plan. Pay the minimum, keep the account in good standing, stay current until things ease up. And in the narrowest sense, that logic works. Make your minimum, and you're not late. You're not racking up penalty fees. On paper, you're fine. But not late and making progress are two very different things, and the gap between them is where this gets expensive. Here's the belief most people hold. As long as I make the minimum payment, I'm slowly paying this off. And technically, you are. The question is, how slowly? Because depending on your balance and your interest rate, slowly can mean a decade or more.
It's too challenging. I just won't do anything. That's why we have half of Americans literally living paycheck to paycheck. And we also have half of Americans carrying a balance month to month on these credit cards, right? It's revolving.
And the reason why is built right into how that minimum number is calculated. That's the part they don't explain on the statement. So let's explain it. Most card issuers set your minimum one of two ways: a flat dollar amount, usually around $35, or a small percentage of your balance, and whichever is larger is what you owe. A very common version used by major issuers is roughly 1% of your balance, plus all the interest that built up that month. Here's the catch. With a percentage-based minimum, the payment shrinks as your balance shrinks. Every month you pay the minimum, next month's required payment is a little smaller. That feels like progress, but it's actually the opposite. Because most of that payment is going to interest, only a thin slice is touching the actual debt. And as the payment shrinks, that slice gets thinner. Let's put real numbers on it. Say you owe $5,000 on a card at 22% interest. Roughly the national average for accounts that carry a balance. You make no new purchases and you pay only the minimum every month, using that standard formula. Running that forward, it takes about 16 years to pay off that $5,000. And over those 16 years, you'd pay roughly $7,700 in interest. Meaning your $5,000 balance ends up costing you around $12,700 total. But the total number isn't even the worst part. Look at where your money goes along the way. By year 5 of paying the minimum, your balance is still around $2,700. Your minimum payment that month is about $78. And of that $78, roughly $51 is just interest. Only about $27 is actually reducing what you owe. 5 years of on-time payments, and most of each one is still feeding the interest. That's not a glitch. That's the design working exactly as intended, and the math gets steeper at higher rates. Recent data found the average rate on general-purpose credit cards hit 25% in 2024, the highest in nearly a decade. Store cards averaged over 31%. At those rates, the same balance stretches even longer and costs even more.
A new study from Bankrate found the interest rates have reached a record high. Bankrate surveyed 108 cards from leading retailers in September. At the time, the average rate was 30%.
Now here's a consequence most people miss entirely: what minimum payments quietly do to your credit score. Credit utilization is one of the biggest factors affecting your credit score. How much of your available credit you're using. Carry a high balance for years, and that number stays high for years, which can hold your score down the entire time. That's not abstract. A lower score can mean a worse rate on your next car loan, your insurance, or eventually a mortgage. And there's a cliff hiding in here too. Miss a single payment, and many issuers can apply a penalty rate, often around 30%.
Interest rates on retail credit cards spiked to record highs of nearly 30%.
This year alone, I've lost over $2,000 just in fees.
It's going to really affect those small family businesses, those self-employed businesses.
Consumers pay $1.2 billion in card surcharges annually.
Somewhere along the line, someone's going to have to pay for it, either the consumer, the retailer, or the banks themselves.
And a payment that goes 30 days late typically gets reported to all 3 credit bureaus. A single late payment can significantly damage a strong credit score, sometimes by dozens of points depending on the rest of your credit profile. And that mark can remain on your credit report for up to 7 years. Those are general estimates, not a guarantee. Your mileage depends on your full profile. But the direction is clear. The minimum payment path leaves very little room for one bad month. So step back and look at what the minimum payment really is. It keeps you current, it protects you from fees, but it lets interest silently inflate the true cost of whatever you borrowed, stretched across years. And if anything goes wrong along the way, the penalties stack fast. Which raises the obvious question: if it's that costly, is paying the minimum ever the right call? Actually, sometimes yes. If your real choice is between paying the minimum and missing the payment entirely, the minimum wins almost every time. A missed payment can trigger fees, a penalty rate, and a credit hit. The minimum keeps your account current and protects your payment history, which is the single biggest piece of your credit score. About 35%. A tight month, a gap between jobs, a surprise expense. That's exactly what the minimum is for. It buys you time without a serious penalty. The danger isn't using the minimum in a pinch. It's mistaking a short-term lifeline for a long-term plan. And the flip side is genuinely encouraging, because the same math that traps you can work for you fast. Take that same $5,000 at 22%. Paying just $50 a month above the minimum drops your payoff from about 16 years to a little over 5 years. And cuts your total interest by roughly $4,900. You don't need to double your payment. A small, steady amount above the minimum changes everything. One more piece of context on the scale of all this. In 2024, about 15% of general-purpose cardholders and 20% of store card holders were paying only the minimum. And notably, the biggest increases were among people with prime and near-prime credit. Not just borrowers in trouble. This isn't only happening to people in financial distress. Altogether, Americans were charged about $160 billion in interest in a single year, up from $105 billion 2 years earlier. So what actually happens if you only make minimum payments? In the short term, it works. Your account stays current, your payment history stays clean, and you dodge late fees and penalty rates. In the medium term, it quietly costs you. Your balance barely moves, interest compounds against you every month, and your utilization stays high enough to weigh on your credit score. In the long term, a balance that felt manageable becomes a multi-year commitment that can cost more than double what you borrowed. On our example, $5,000 turned into roughly $12,700 over about 16 years. Time, not spending, is what inflated it. So who is the minimum actually right for? It works as a short bridge. A month or two during a real disruption, when the alternative is missing a payment. It protects your credit and buys you time. It works as triage when you've got a more urgent fire, a higher rate debt, or a bill about to hit collections, and you need to hold the card steady while you deal with the bigger threat. And it works on a 0% promotional card, where no interest is accruing and every payment is hitting principal anyway. Who is it not right for? Anyone using it as a long-term strategy on a standard rate card. Because here's the part worth sitting with. This isn't just a people in trouble problem. The data shows plenty of prime credit card holders revolving balances on the minimum too. The trap isn't about being bad with money. It's about not seeing what the math is doing, and the math is very patient. The real question isn't can I afford the minimum? It's can I afford what this debt costs at the minimum? Here's the one thing to take away. The minimum payment is a flaw, not a strategy. It's there to keep you current in a hard month, not to get you out of debt. Treat it as a temporary tool, and it's useful. Treat it as a plan, and it can cost you years and thousands of dollars. And the encouraging flip side is real. You don't need a dramatic move to change the outcome. Even a small fixed amount above the minimum, $25, $50, $100, can cut years off the timeline and save you serious money in interest. Consistency beats size. So here's the question I'll leave you with. That warning box is printed on every single statement, by law, showing you exactly what the minimum will cost you. So why do so few people ever read it? And would it actually change anything if they did? Tell me in the comments. Do you pay the minimum more than the minimum? Or have you landed on a system that actually works for you? And if you like money questions examined this way, looking at whether something is actually worth it instead of just taking the common wisdom, consider subscribing. That's the whole point of this channel.